Good planners pursue ambitious dreams but anchor themselves on down-to-earth realities. The good planner must visualize a rosier and more robust tomorrow. He or she must envision success and a resounding victory for the enterprise. However, there are the stark facts which the planner must consider. The planner must decipher industry trends, economic cycles, and market changes. The planner must discern the most attractive and most viable opportunities open to the enterprise while recognizing real threats and potential pitfalls. The planner must be able to pinpoint specific micro-market locations, venture projects, and sound deals among the 1,001 opportunities available. To be sure, it will not at all be easy sailing for the enterprise, for there will be many competitors, a plethora of government rules and regulations, stringent stipulations set by financial institutions, technology hurdles, organizational miscreants, and plain old bad luck. In between today's realities and tomorrow's dreams, there is a wide chasm. The planner must build a connecting bridge to solve the riddle of how to get from one side to the other. This bridge is the strategy that must be built on the fundamentals of the prevailing marketplace and the visionary unveiling of what the future will bring. Planning is a deliberate exercise that begins with the end in mind. From that end, the planner must work backwards and end at the beginning, which is today. To articulate their dreams, many enterprises have vision statements. This vision statement describes where the enterprise will be within a given time horizon. It is placed in the context of the environment or industry the enterprise is in. It describes what business and market focus the enterprise will have and how successful the enterprise is projected to be. A vision is a futuristic profile of the company. A vision statement merely describes that profile. Side by side with a vision statement stands the enterprise's mission statement, which proclaims the basic purpose for being of the enterprise. Almost all entrepreneurs put up a business to earn a decent, if not indecent, return on their investment. They all want to be a significant player in their industry or to capture a sizable slice of the market pie. They all aspire to be known as excellent providers of products or services that delight and excite customers. They also desire to be good employers and meritorious members of their communities. These wants, desires, and aspirations of entrepreneurs comprise the basic purpose for establishing the enterprise. Taking the enterprise vision and mission statements into account, the entrepreneur then targets measurable end results that he wants to achieve. These measurable end results are called objectives. They define what the enterprise wants to end up with after a defined period of time, be it a year, 5 years, or even 10 years. Objectives, though measurable, are stated in very broad terms such as 1. To achieve market leadership. 2. To earn a reasonable return on investment. 3. To delight customers with high-quality products and services. 4. To improve the well-being of its employees. Key Result Areas, or KRAs, are specific manifestations that the objectives are being realized. These specific manifestations can be quantified through performance indicators, or PIs, that are attainable within a definite time frame. Thus, the objectives are translated in KRAs, while the KRAs are quantified into PIs. All the performance indicators of an enterprise should be mutually reinforcing and internally consistent. One way of ensuring this is to put them together in a holistic model. Enterprise Planning and Performance Evaluation. An enterprise planning and performance evaluation model, which puts all the management functions and processes together, is depicted in Figure 9. On the right side are the 3 ultimate measures of enterprise performance: customer satisfaction, market performance, and financial performance. The first has to do with delighting and exciting enterprise customers, which leads to the second measure of meeting market targets such as sales levels, reach, and efficiency. The third is the bottom line result, which accrues to the stockholders. Let us start with the financial performance measures. Stockholders expect to generate a lot of wealth. If their shares are listed in the stock market, they would be looking at the market price per share of their enterprise. If not, they would still be valuing the market worth of their company to potential investors or buyers. Creating this market value is a function of the past, present, and expected future performance of the company. It is a function of what assets or resources the enterprise has, its leadership and managerial capabilities, its technological capital, its market reach and growth potentials, its operational efficiency, its customer satisfaction level, and its attractiveness to other investors. It is also a function of the industry to which the enterprise belongs. The market value of an enterprise therefore encapsulates the sum total of its performance and potentials. The enterprise planning and performance evaluation model starts with the questions: what business are we really in? What do we want to accomplish? What outcomes do we want? What products or services must we produce and deliver in order to attain our customer, market, and financial objectives? Having answered these questions, the enterprise begins to muster the necessary inputs to produce the best products and services. This is shown in the operations planning and budgeting process. The 5 M's of manpower, machinery, which also includes buildings, land, and so on, materials, methods, and management are inputs brought to bear on a transforming unit, such as the factory or service shop. In the transforming unit, technology is applied, systems and procedures are defined, and operating work processes are designed and put to work. In the actual transformation of the 5 M's into products and services, hopefully there is a proficient and efficient usage of the inputs and an excellent application of management talents. This is known as the transformation process, or the operational throughput. Finally, the enterprise comes up with output or products and services of a certain quantity and quality. During the transformation process, the enterprise incurs product costs, which eventually make up the enterprise's costs of sales or cost of goods sold. Operations performance measures are applied by the enterprise to ensure efficiency, effectivity, and economy. These measures include input-output, throughput time, wastage and reject levels, capacity utilization, and quality control measures. In the production of goods and services, the enterprise also incurs general and administrative expenses that include the head office salaries and wages, rental payments, travel, representation and transport costs, maintenance, janitorial and security services, and other such overhead costs. These become part of the enterprise's operating expenses. Market planning and budgeting endeavors to bring the products or services to the marketplace successfully. Of course, this starts with the first P, or the product, which must be made presentable in an attractive and appropriate package, which is the second P. The enterprise then puts the right price, the third P, to the product. The product is then sold through salespeople, which is the fourth P, in a well-chosen place, the fifth P, or location and distribution system with the proper promotions and advertising, which is the sixth P. The 6 P's combined work to penetrate the market and attain a certain sales level, a wide enough market reach, and a sizable share of the market through efficient and effective sales efforts, which are the market performance measures. The sales attained enter the top line of the income statement. The selling expenses, which include the 5 P's of marketing, except for the product, enter the operating expenses along with the general and administrative expenses. Since we have now assembled the sales, cost of sales, and operating expenses, we can proceed with our financial planning and budgeting exercise. The sales, cost of sales, and operating expenses enable us to derive operating profit. Next, we must ensure that we have enough resources or assets to produce the sales and support the cost of sales and operating expenses. Then we must determine what sort of financing we need, which encompasses liabilities management or the determination of our capital structure, such as short-term debt, long-term debt, and stockholders' equity. Doing so enables us to plan or forecast our balance sheet composed of current assets and fixed assets on one side, and the short-term debt, long-term debt, and stockholders' equity on the other side. The assets and liabilities may include non-operating income, and incur non-operating expenses which we must add to or subtract from the enterprise's operating profit. This results in our net profit before taxes. We deduct the taxes to produce net profit after taxes, thereby completing our income statement. Depending on our operations, marketing, and administrative performance, we can now measure our financial performance. Hopefully, we are able to produce products or services with high profit margins or return on sales. We also aspire to have a good asset turnover, which implies that we are able to generate the most sales out of our assets. A high return on sales combined with a good asset turnover, or sales over assets, will result in a high return on assets or profit over assets. A high return on assets combined with good financial leverage, which is assets over equity, will result in a high return on equity or profit over equity. This in turn produces a high earnings per share or net profit after taxes over the number of outstanding equity shares. A high earnings per share multiplied by a high price earnings multiple for the enterprise will result in a high market price per share of the enterprise, which is our ultimate enterprise performance measure. This completes a full cycle of the enterprise planning and performance evaluation model. Profit planning and cost budgeting. The concept of variable and fixed costs, described in Chapter 4, Interpreting Financial Statements, is important in profit planning and cost budgeting. As an enterprise peers into the future, it would like to know two things: how revenues will rise or fall, and how costs will behave in relation to the revenues. Total variable costs rise proportionally to sales volume. If sales go up by 20%, so will variable costs. Fixed costs do not necessarily go up with sales. They may go up, however, because of management's decision to increase salary levels, the landlord's prerogative to raise rental rates, and other extraneous factors such as inflation. There are also semi-variable costs that move in the same direction but less proportionately to sales volume. They are semi-fixed and semi-variable. An example would be electricity costs. The power company supplying electricity may charge a minimum fixed fee up to a certain number of kilowatt hours used. Thus, for volumes of productions and sales up to that certain level, electricity charges will be fixed. However, above that minimum number of kilowatt hours, the electric company may charge according to the number of kilowatt hours used. Hence, power costs will be a variable cost when beyond the electric company's minimum level. Semi-variable costs can be broken down into their fixed cost component, which is usually up to the minimum level, and their variable cost component, which would be beyond the minimum level. There are costs that may vary in steps, or change in discrete volumes. An example would be the adding of a second shift as sales volume rises beyond what the first shift of workers can handle. Another might be the adding of branch managers and branch personnel as the company expands its sales reach. These costs are called step function costs. Semi-variable and step function costs complicate the analysis of cost behavior as sales volume increases over time. The longer the time perspective and the greater the sales volume range, semi-variable and step function costs become more prevalent. It is possible, however, to break down the semi-variable and step function costs into their fixed and variable cost components within a short period of time and within a relevant sales volume range. Step function costs will probably be fixed within a short period of time and within a limited sales volume range. Semi-variable costs probably will be more variable than fixed at higher sales volumes. Knowing this allows us to chart the behavior of costs in a linear equation. Let us suppose that all costs behave either in a variable or in fixed pattern within a limited time and range. In this case, total costs are nothing but the addition of fixed costs and variable costs. Variable costs at any given volume is simply a multiplication of unit variable costs, or the variable costs divided by the number of units and the sales volume, which is just the number of units. This means that total cost equals fixed costs plus unit variable costs multiplied by volume in units. Graphically, Fixed costs will remain the same over a certain period of time and over a specific volume range, while variable costs will go up as sales volume rises. Adding up the fixed cost and the variable cost will give us the total cost. Fixed costs, by definition, remain at 400,000, whether the enterprise produces 0 or 100 units. This implies that a variable cost moves up from 0 at 0 units to 600,000 at 100 units, or 6,000 per unit. We can see then that variable costs at 50 units would be 6,000 times 50, or 300,000. Total costs at 0 volume would be just the fixed cost of 400,000. At 100 units, the total cost would be 400,000 plus 600,000, or 1 million. This implies a linear function. Total costs at 50 units would be equal to fixed costs of 400,000 plus variable costs of 300,000 for a total of 700,000. Similarly, sales or revenue can also be charted in a linear equation. Sales equal the price per unit multiplied by the volume sold. If the price per unit is 15,000, then the sales at 100 units would be 1,500,000. The sale of 50 units would yield 15,000 times 50, or 750,000. We can now draw the sales and total costs together. Sales are 1.5 million at 100 units, and total costs are at 1 million. Since sales less total costs equals net profit, then the net profit would be 500,000. At 50 units, sales are 750,000, while total costs are 700,000, thus giving us a net profit of 50,000. It is possible for a sales volume to be where sales equals total costs, yielding a net profit of 0. This is called the break-even sales volume. How do we compute for this? We know that at break-even sales volume, sales equals total costs. Since total costs equals fixed costs plus variable costs, then we can say that a break-even sales volume, sales would equal fixed costs and variable costs. We can translate this into an algebraic formula. Sales or revenue equals unit price, UP, of 15,000 pesos multiplied by X units. Fixed costs equals constant number of 400,000 pesos. Variable costs equals unit variable cost, UVC, of 6,000 pesos multiplied by X units. If we let X equal the break-even sales volume, then UP times X equals FC plus UVC times X. 15,000 pesos times X equals 400,000 pesos plus 6,000 pesos times X. 15,000 pesos times X minus 6,000 pesos times X equals 400,000 pesos. 9,000 pesos times X equals 400,000 pesos. X equals 400,000 pesos, or fixed costs. 9,000 pesos, or UP minus UVC. X equals 44.4444. Let us check this out. Sales equals fixed costs plus variable cost. 15,000 pesos times 44.4444 equals 400,000 pesos plus 6,000 pesos times 44.4444. Both sides of the equation equal 666,666 pesos. We can compute and see that the break-even sales volume can therefore be stated as X equals fixed cost divided by the unit price minus the unit variable cost. From chart 2, we can glean that at sales volumes beyond 44.444 units, there will be profit because sales are greater than total costs. Sales volumes below 44.444 units will mean losses because sales are less than total costs. For profit planning purposes, we can use this graph and call it the profit graph. We can also use the total cost, fixed cost, and variable cost lines for cost budgeting purposes. In fact, this is the essence of flexible budgeting. The cost budget becomes a function of what the sales volumes realized is. If the sales volume is high, the cost budget will be high. If the sales volume is low, the cost budget will be low. This is because the variable costs go up and down with the sales volume. Flexible budgeting is differentiated from the fixed budget, where the sales volume planned or budgeted is fixed for the year. Therefore, the cost budget is also fixed. If the sales volume falls, the budget analyst notes a negative variance. However, because the total costs also fall, the budget analyst reports a favorable variance, which means actual total costs are lower than budgeted total costs. The word favorable does not have any real meaning here, because the total costs will necessarily fall as sales volumes fall. Conversely, if sales volume rises above the budgeted figure, there is a favorable variance reported. The total costs also rise because of the rising variable costs. The budget analyst will then report an unfavorable variance vis-a-vis the fixed budget. However, again, this has no real meaning. From the overall enterprise point of view, the higher total costs corresponding to the higher sales volume should result in still higher profit. What is so unfavorable about that? Product line profitability analysis. From the previous discussion, we have seen the relationship of sales volume, costs, and profit. Total sales minus variable costs generate a contribution margin that enables the enterprise to cover fixed costs and produce a net profit. At break-even sales volume, the contribution margin merely covers fixed costs because the net profit stands at zero. As variable costs move up and down with sales in a direct and proportional manner, they constitute a determinable percentage of sales. The concept of contribution margin is a very important one for determining which product line an enterprise should push. Assuming that market potentials are more or less the same, the higher the contribution margin of a product line, the more it should be pushed. Let's take the example of three product lines, A, B, and C. Product line A has sales of 100, variable costs of 70, and fixed costs of 10 for a net profit of 20 pesos. Product line B has sales of 100, variable costs of 50, and fixed cost of 50 for a net profit of 0. Product line C has a sales of 100, variable costs of 30, and fixed costs of 80 for a net loss of 10 pesos. Table 34 also shows what would happen if sales were doubled to 200 pesos. Of course, variable costs would double while fixed costs would remain the same. If sales were tripled, variable costs would also triple while fixed costs would remain the same. From Table 34, we see that given sales of 100 pesos for each, product line A is the most profitable. Product line B stands at break-even while product line C incurs a net loss. However, when sales triple to 300 pesos, product line C has the highest net profit at 130 pesos, followed by the product line B at 100 and product line A at 80 pesos. The profit picture has been reversed. Why is this? The reason for the reversal in the profit picture is the contribution margin. For every peso sale of a product line A, there is a variable cost of 70% or 0.70 pesos. This means it has a contribution margin of 0.30 pesos. For product line B, for every peso sale, variable cost is 50% or 0.50 for a contribution margin of 0.50 pesos. For product line C, variable cost is 30% or 0.30 pesos for a contribution margin of 0.70 pesos. Therefore, for every peso sale added to each product line C would slowly surge ahead, profit-wise, until it overtakes product lines A and B, all because of its larger contribution margin. The example given above is about 3 product lines with different processes and different fixed cost components. Let us take an example with product lines utilizing the same machinery and equipment. Overall enterprise fixed cost would remain the same irrespective of the product lines being produced. However, the different products D, E, and F have varying machinery and equipment capacity utilization. If the machinery and equipment produce only D, they can churn out 100 units. If only E were produced, the output would be 150 units. If only F were produced, then the output would be 200 units. Product D, however, has a variable cost percentage of 60%, while E has 70% and F has 80%. The enterprise has fixed costs of 30 pesos. Table 35 gives the profit picture at different sales levels, assuming the machinery and equipment were dedicated to only one product line. The table assumes that the unit selling price of D is 1 peso 20 centavos, E is 1 peso, and F is 80 centavos. We can see that the enterprise would be better off producing just product line D, because the net profit would be higher at full capacity utilization, even if the total output is only 100 units. This is so because the higher selling price and lower variable cost percentage of product line D results in a higher contribution margin and a higher net profit. The master budget. When enterprises prepare budgets, they usually do 3 types. The first one is the operating budget, which includes budgeted sales, cost of sales, and operating and other expenses. The second is the cash budget, which attempts to determine cash receipts and cash disbursements for the budget period. The third is the capital expenditure budget, which evaluates alternatives and decides on the acquisition of fixed assets such as land, buildings, machinery, and equipment needed by the enterprise. For this purpose, a budgeted balance sheet is prepared. The operating budget and cash budget are explained here, while the capital expenditure budget is treated separately in Chapter 8. These 3 types of budgets comprise the master budget of the enterprise. The operating budget. There is a marked difference between financial forecasting and budgeting. Forecasting is a prediction of what may be the most likely outcome of an enterprise's business activities and their effects on the company's finances. Budgeting, however, is a deterministic, proactive, and deliberate process to attain certain market, operations, and financial objectives. It sets goals and targets. It establishes certain standards for operating efficiencies and cost economies. It commits people at the top, middle, and first-line management levels to a common set of objectives that are quantified in monetary terms. Sales targets may be set higher than the sales forecast in order to motivate, cajole, and even coerce the marketing and sales force. A similar targeting exercise is done for the other units of the enterprise. As part of the budgeting process, the enterprise uses incentive schemes, or carrots, and performance evaluation systems as sticks to energize everyone in the organization. The attainment or non-attainment of budget targets is monitored and evaluated by top management or departmental heads. Variances from the targets, whether favorable or unfavorable, are explained. Causes and their effects are studied in order to improve the enterprise performance. The sales budget is the most contentious item in the operating budget because it defines most everything else. The sales budget will determine how much production capacity is needed, how much working capital is required, and what general, administrative, and selling efforts must be exerted to realize the sales target, how many people must be hired, and so on. The enterprise must figure out what product or service lines to push, how many units of each product must be sold, where and how. Pricing must be determined for each item. Given the price, quality and quantity parameters of product or service, the enterprise can then proceed to make the sales budget. This must be negotiated between the top management and the marketing and sales groups. The next most important budget item is cost of sales or costs of goods sold. In order to produce the finished goods or services, the enterprise must determine what inputs are needed in terms of materials, labor, machinery and equipment, factory space, supervisors, maintenance crew, and other such inputs. Inputs directly related to the production of goods are called direct costs. The enterprise may come up with certain standards that reflect an efficient input-to-output ratio. This means just the right amount of inputs to produce the desired quantities of quality finished goods or services, and with the minimum of reject and wastage. The standard input-output ratios can then be translated into standard costs after determining the expected costs of all the inputs required for the budget period. The enterprise may translate the total standard costs into per-unit cost estimates. In the production of goods and services, indirect costs are encountered, and these will form part of the manufacturing or service overhead. The direct and indirect costs of providing a product or service are added to come up with total cost of sales or cost of goods sold. Some enterprises prepare flexible budgets while others prefer fixed budgets for determining their production costs. Lastly, the selling, general and administrative costs are budgeted. The enterprise goes on a per-item analysis here. The biggest cost item is the salaries and wages of the head office and non-production personnel. The enterprise must determine the optimum manpower complement needed to support the general, management, and selling activities of the company. The next biggest cost item would be the selling expenses, which include commissions, advertising and promotions, distribution and delivery costs, and rental of sales outlets. Representation, entertainment, travel, and other managerial perks may be significant for some enterprises, but frugal for others. The enterprise goes through the other expenses meticulously in order to keep the operating budget lean and mean. The enterprise periodically reviews the operating budget and effects changes if market conditions change significantly. The operating budget is subjected to an evaluation whereby variances in the budgeted figures are examined and explained, and the actual performance of the different units of the enterprise is monitored. This performance monitoring may serve as the basis for personnel promotions, rewards, and recognition, or sadly, the basis for firing non-performing individuals and groups. The cash budget. The entrepreneur or finance manager is concerned about the enterprise's survival on a day-to-day basis as well as its long-term sustainability. Cash is the precious commodity that will make the enterprise live on and on. It is crucial, therefore, to monitor and budget the enterprise's cash position on a daily, weekly, monthly, and yearly basis. The entrepreneur or finance manager should determine the cash receipts and cash disbursements that the enterprise is most likely to experience. If there are projected surpluses or shortages, these should be added to the beginning cash balance to determine the ending cash balance. If the ending cash balance turns out to be positive and stays above the minimum cash required, there is no need to raise funds. Excess cash can then be placed in marketable securities or other forms of investments. If the ending cash balance is negative, then there is need to borrow short-term funds for seasonal requirements or to borrow longer-term funds for long-term requirements. The nature of the cash needs can be established by forecasting the cash situation over a longer time frame. The cash budget or cash flow forecast should indicate whether excess cash is likely to accumulate. In this instance, the surplus cash can be placed in longer-term investments. If the excess cash will be needed in future operating periods, then the enterprise is well advised to place it in very short-term investments. For cash shortages, the enterprise must obtain additional loans. The cash forecasting period must therefore be extended to ascertain whether the loans can be repaid or not. If the cash forecast shows repayment difficulties, then additional equity must be sourced. However, if the future forebodes continuing cash shortages leading to bankruptcy, there may be reason to preempt that bankruptcy by liquidating the company before mounting cash shortages eat up all of its assets. The cash budget emanates from the forecasts made on the income statement and the balance sheet, except that these financial statements follow the accrual method of accounting. On the one hand, the income statement recognizes sales when they are transacted, not when they are collected. The cash budget, on the other hand, only recognizes cash collections from sales made. Also, the income statement recognizes cost of sales, operating expenses, and non-operating expenses that can be matched to the sales transacted during a period. However, the cash budget only recognizes cash payments on purchases made and expenses incurred, regardless of the time when those purchases or expenses were transacted. The cash payments may occur before, during, or after the income statement period. The cash budget should take into account the credit terms given to the customers and provided by suppliers. Doing so implies a delay in the collection of cash, or accounts receivables, and a delay in the payment of purchases, or accounts payable. The cash budget must distinguish between actual cash receipts and disbursements, and the accountant's accrual method of recording sales, cost of sales, and operating expenses. Take the following example of Acme Enterprises. It has a policy and actually experiences a 30-day sales collection period. It purchases the raw materials and pays for the labor costs and outlays for overhead expenses in cash 1 month before they are recognized as cost of sales. In other words, Acme's products must be produced 1 month before they are sold. 80% of the selling, general and administrative expenses are paid for in cash during the operating month. However, 20% is paid 1 month later. Interest expenses on long-term debt are paid on June 30 and December 31st. The amortization of principal payments is also paid on the same dates. Half of the taxes for the previous year's income is paid on April 30, while the other half is paid on July 31st. Income taxes are pegged at 25% of net income before taxes. Beginning cash balance as of January 1st, 2000 is 25,000 pesos. There is enough information to project a cash budget for Acme Enterprises. This is shown in Table 37. We must start with the beginning cash balance, which is given at 25,000 pesos. To this figure, we must add all expected cash receipts. These include cash collections from the previous month's sales because of the 30-day credit policy. For Acme, there are no other cash receipts like loan proceeds, cash payments for sale of assets, and cash advances from customers as other enterprises might have. The sum of the beginning cash balance and the cash receipts or cash collections equals the available cash of the enterprise. From this available cash, we must then deduct all expected cash disbursements. These include materials, labor, and manufacturing overhead for the next month's cost of sales or cost of goods sold, since the products must be produced 1 month before, which means that cash is also disbursed 1 month before. Depreciation is a non-cash item and never enters the cash budget. Next, 80% of the month's SG&A expenses is paid for in cash on the month incurred. The remaining 20% is paid 1 month later. Taxes for last year's net income are paid this year. The taxes for the year 2000 is computed at 2,000 pesos. 50% of this, or 1,000 pesos, is due on April 2001. Next, principal payment on the loan is to be paid on June 30, 2001. It amounts to 50,000 per semester, or 100,000 pesos per year. Finally, The interest expense of 36,000 pesos for the months of January to June are paid on June 30 of the same year. The total cash disbursements are tallied. From the available cash, we subtract the total cash disbursements to derive the ending cash balance, which becomes the beginning cash balance for the next month. Table 37 gives us the cash budget of Acme Enterprises for January to June 2001. Note that the ending cash balance of Acme Enterprises remains positive from January to June 2001. If the cash budget shows a negative cash balance, the enterprise must raise some cash to fill the cash shortfall. The enterprise may elect to do any of the following. 1. Borrow money. 2. Ask shareholders to infuse more cash into the enterprise. 3. Sell some assets. 4. Postpone or restructure the loan payments. 5. Postpone the payment of raw materials by asking for longer-term suppliers' credit. 6. Delay the payment of certain selling, general, and administrative expenses, or 7. Other means. We can now move to capital investment analysis.